Today, folks, we're diving into my two favorite dividend ETFs because I feel it's relevant to reiterate why these are such powerful ETFs compared to all the dividend ETFs that exist out there. And of course, we're going to be breaking down SCHD and offering some updates around the Schwab US Dividend Equity ETF. And then on the Canadian side of the border, VDY, the Vanguard Monthly Paying High Dividend Yield ETF. And if that is a conversation you'd appreciate on your path to financial independence and perhaps one day retire early, consider hitting that like button because many of you are familiar that I have been buying SCHD aggressively as a Canadian because I can hold this in my registered retirement savings plan and basically collect the dividends without any of the withholding tax, because many of you know if you're buying over the border stocks, you pay a 15% withholding on the dividend. And because I want to retire early and I don't want to wait till I'm 60 or 65 to start drawing out of this retirement account, I will start to draw out of it early, at which I'm going to have to pay my general income tax on the gains and dividends. But the cool thing is I never have to sell the ETF and I can just draw the dividends when I'm ready to do so. But taking a look, I've got about 53,000 US sitting in this ETF currently, and I'm up about 8 percentage points. And I want to get into why I love this ETF, even though the yield isn't like absolutely absurd. I mean, it's only just offering over a 3% yield, which doesn't get that many people excited, but I do want to iterate the value of getting performance and income that is growing over time. So your initial investment will have a higher yield on cost as the 5, 10, 15, 20 years pass. But what I want to talk about first and foremost is the stock performance. The hardest thing to find in the market is high yields and high growth out of your capital performance, right? And I always believe that total return matters more than just income, especially if you're not doing it tax efficiently. But if we compare SCHD to basically VYM, you've got DGRO in here. And then for those of you that love option ETF income, JEPI, the JP Morgan equity, I think this is what the premium income ETF for basically those looking for option income, which is a way higher yield. But you can see that JEPI really lacks the performance because it's paying so much in dividends, right? But we can see that SCHD is actually performing in line over a 5-year period, basically with DGRO, which holds a lot of companies that are more tech oriented like Microsoft in there. But I always like to zoom out and just say, hey, like, what's the stability look like? What is the stock chart in comparable to these ETFs look like? And SCHD has actually outperformed all of these pretty consistently for 5 years, up to recently just slightly lagging DGRO. But because I already hold the S&P 500, it's the largest position in my portfolio, is VOO, and it gives me crazy tech exposure. I don't want that same kind of tech exposure out of my dividend income ETFs, right? So SCHD, I believe, offers that incredible diversity. And then we got to talk about dividend growth. Now, recently, the dividend hasn't been growing as aggressively as I'm sure people would like because they've been kind of reconstituting the holdings and adjusting them, obviously basing on value and a lot of other metrics. But if we do zoom out over a 10-year period, I mean, 10 years ago, you were getting 25 cents. The last dividend was 61 cents. The peak around 74 is a pretty absurd increase. I mean, we're talking about almost a tripling of the dividend here. If we take a look at that dividend scorecard, we can actually see that you're talking about 11.8% 5-year growth rate over 12 years. You know how crazy that even 5-year growth rate, 11.8%, but the dividend growth has been over 12 years. This is just maddening numbers. Like, you hardly see this at a higher yielding stocks. Like, a lot of the bank stocks here in Canada, many of the most renowned dividend stocks do not offer that kind of growth. So for the broader ETF to have done that successfully in 5 years, I gotta say, it's worth an applaud, right? So let's talk about the holdings as they exist today. If you've looked at the holdings in this, you'll recognize that this is a Dow-oriented ETF. The Dow Jones Industrial is more or less a defensive, basically a defensive indice. And if you take a look at the holdings in the Dow, you can see that Amazon, which actually only recently got added, I think as of February this year, but you've got American Express, Amgen, Apple, Boeing, Caterpillar, Cisco Systems, Chevron, Goldman Sachs, Home Depot. So you see, this isn't as tech oriented. You know, you've got Intel Corp, Johnson & Johnson, Coca-Cola, McDonald's, 3M, Merck & Company, there's Microsoft, Nike, Procter & Gamble. These are very like consumer oriented kind of businesses. So when you take a look at SCHD, you can see that they're looking for the value in these stocks, ones that have great yields, great yield growth, but are trading a little bit more favorably because you can see they sold Broadcom out of this list. They've been adding things like Hershey into the list. You can see you got things like Lockheed Martin, which is a highly defensive play. Pfizer, that's been absolutely getting destroyed, is in here. Like I said, Verizon has also got destroyed pretty heavily. And these are companies that I love. Like, I absolutely love. When we take a look at the holdings and just kind of scroll through the quick list here, because there are a lot of holdings, whereas the top ones are all weighted by about 3 to just over about 4.5%. But you got Coca-Cola, you know, BlackRock's in here. Again, Home Depot's amazing. Bristol-Myers Squibb. Altria Group, though I'm not the biggest fan, I could see why it would be in here. Ford Motors, again, not the biggest fan. I don't have to agree with all of these, but it is truly passive because the management is not in my hands. And that's another reason that I love these ETFs. This one specifically because it is a little bit more hands-on managed and comes with a lot less of a maintenance fee, which is really surprising considering it is kind of one of these non-market cap weighted ETFs, which we'll talk about with VDY. But there's a lot of great holdings here. Absolutely love the ETF. You can see it's primarily divvied up in a very diverse sector manner as well. 17% financials, 15% healthcare, 13% consumer staple, 13 industrials, 12% energy, consumer like very, very properly diversified. So I don't think there's any complaints here. Right now, you're paying about 0.06% on the expense. And if you're paying attention to the yield, the 30-day SEC yield is about 3.77%. Beautiful. Muy bien. So let's talk about my next favorite here, which is VDY. Now, between me and my fiance, we do own a fairly sizable position in this. It's nothing huge because we are still looking for growth in our age, and we see a lot of growth in the US still. But as time goes on, you'll see that this is going to become a much larger weighting in my portfolio because it is just a market cap weighted, just like the S&P 500 dividend ETF, but is oriented toward Canadian dividend stocks, which gives me the ultimate tax benefits. You know, I'm a Canadian. I'm not trying to be like country biased because I recognize the growth isn't here like it is in the States. But let me get into the details and you'll kind of understand better why I own this. First and foremost, I mean, you take a look, I'm not up a lot on this, and I'm holding it in my TFSA. And the reason I'm going to hold it there is because eventually I'm going to get to the point, like I said, where I'm not going to sell any stocks. I'll sell my growth stocks like Tesla, probably oriented to the S&P and more of these dividend ETFs. So I can just infinitely draw that money without ever touching the initial investments. So this is going to scale pretty dramatically over time. Like I said, it's only about a 10K position right now. And let's just take a deeper look into it because the stock performance hasn't been that appealing. We are only up about 4.78% this year. Surprisingly, however, doing better than SCHD on the year. But as mentioned, I like to zoom out. The one-year performance or year-to-date performance means nothing to me. And if we zoom out, we're up about 30%. Again, you compare that to SCHD over 5 years, not nearly the same performance. You're getting a little bit of a higher yield. But again, I don't need the exact same performance to just get better diversity of my income. Now, if we look at the comparable performance against the most famous Canadian dividend ETFs like XDIV, I think XCI is a big one. You have the BMO Equal Weight, bank ETF. And if you just take a look here, what I find most fascinating, again, is I'm looking for stabilized performance in the stock price, along with appreciation over time. If we're not, again, this has nothing to do with yield performance. But if you just take a look here, you can see that in the blue line, VDY has actually pretty much kept up with the bank ETF ZEB, which is just focused on those 5 or 6 big banks. And you can see it's actually traded above almost all of these ETFs through its history. So that really kind of tells me that, whatever they're doing here, it's performing much better than many of these other Canadian dividend ETFs. So if we take a look at the dividend performance here, it's a little bit rockier because you have to keep in mind this is a monthly paying ETF. But if you zoom out on the far chart, you can see over time that it does start to concentrate in, and you can see that the payments have gone up pretty dramatically. So let's see what the dividend scorecard looks like in comparable to SCHD. We're getting a 5-year of 8.43%, right? Dividend growth over 2 years. This growth rate is very nice. Again, much higher still than you have to imagine a lot of even individual dividend stocks offer. So again, I just want to say that like the lowest payment you would have got 10 years ago was around 6-7 cents. Today, your lowest payment's about 15 to the higher end about 19 cents. So you can see you're getting well over doubling of the dividend here as well, which is great to see. Again, for something that does pay a monthly yield. So let's talk about how these holdings have changed because unlike SCHD, this one doesn't base its metrics off the underlying stock value, the dividend performance. It is purely just the dividend stocks that are the top weighted on the Toronto Stock Exchange. Now you're paying a much higher management fee, usually 0.2, 0.3% is my breaking point. Currently getting about a 4.71% yield. You got to take management fee off. You're getting about 4.5%. But let's just scroll down a bit. First thing I will point out here that is really neat. Let's talk about the actual rate of return. Basically over 5 years, if you invested in this 5 years ago, 10 grand, grand. That 10 grand today would be worth about $16,397. That is amazing to see. And I think we can see something similar to SCHD here if we find the performance, right? Let's just take a look here because I think it will show you the actual return values of a $10,000 investment. So since or about 10 years, so we'll take a look at the 10-year here. From 2014, if you invested $10,000, your investment today would be worth what, $28,000. Yet that's an amazing over doubling of your money, right? I don't think you could ask for better returns from a dividend ETF. If we zoom out since inception with this guy here, which goes back just before 2014, you'd be getting about $26,000, $27,000 as well. Actually, that's kind of comparable performance to SCHD, a little bit farther than 2014. Keep that in mind. So not as great performance, but very similar performance from two insanely different ETFs, right? But let's again scroll down. This one is a lot more concentrated here, folks, and you have to imagine that's because the Canadian economy is a lot smaller. So 56% is focused on financials. You've got 29% in energy, 5% utilities, and about 5% telecom, basic materials, almost unmentionable in the ETF. With Royal Bank now at 14%, since Toronto Dominion Bank has been getting hit so heavily, it's slowly been de-weighting in this ETF down to about 10.6, but highly concentrated in two stocks. 25% of your entire money is going into two stocks. I would never make VDY a core concentrated position in my portfolio just because of how concentrated it is in those two positions. You really want more diversity in your income, especially if you're going to be relying on this in your retirement. But again, these are the two largest companies in Canada, by the way. I'm not overly worried about it, but it's good to pair with, like, SCHD or some of these other ETFs. Now, Canadian Natural Resources in third, Enbridge, Bank of Montreal. You will notice that Manulife is slowly working its way up, becoming one of the largest companies in Canada. Is obviously insurance has just been crushing it lately. But again, you got things like Suncor, and I'd obviously say that Enbridge here being a pipeline company, very interesting. I wouldn't even put that in the energy industry as much as I would be a utility. It's crazy how big Enbridge has become. But yeah, and it gives you all these banks, your favorite banks, like Pokemon cards, collect them all, Bank of Montreal, Bank of Nova Scotia. I don't think you can really go wrong with this ETF. So to just summarize, I think pairing this with SCHD brings the best of both these economies together. They give you an average yield combined of over 4%. Because again, if you're getting about 4.5% on VDY, and you're divvying this up, evenly between the 3.7% that you're getting off SCHD there, you are getting that rounded position of over 4%. Now, obviously, I own a lot more SCHD than I do VDY, but again, as time goes on, you'll start seeing these kind of become a little bit more equal weighted. I'll probably always lean a little heavier to VOO for the growth, keeping that around 40 to 50% exposure, and then get that nice bump up of SCHD VDY. And then over time, I'll sell my tech positions and continue to scale these ETFs as I get closer to that financial independence goal. But I'll pass the question off to you. I'd love to know what you think and what your favorite dividend ETFs are in that comment section below.